Good afternoon, everyone. How's everybody doing? Good? Okay, great. So Matt and I have the great pleasure to be with you today to speak about a very important topic that both of us are very passionate about, which is financial inclusion. How do we serve the unbanked around the world? And it's a little funny anecdote I wanted to make when Andres asked us to talk about this. He mentioned to me the title of the panel is going to be, serving the 2.5 billion unbanked around the world. And I said, wait a second, Andres, it's not 2.5 billion. That number is about 6 years old from the World Bank. It's more like 1.7 billion. And in those 6 years, there's been a tremendous progress in bringing people to become part of the formal financial system. But, we still have a lot more to do. And one of the biggest enablers to that is technology. FinTech has played a crucial role in emerging markets like Africa, India, Southeast Asia, China, and Latin America to really drive this. So today I'm very grateful to be here with Matt because Matt has been the founder and the CEO of a startup before this one called Kiva, which did crowdfunding for donations for social impact. And now he's the CEO and founder of Branch, which is a very interesting company that does micro-lending in Africa and helping those people who never had a bank account to be able to use the financial system and actually be able to get loans to help them with their way of life. So Matt, maybe we start telling us a little bit about Branch, what led you to start Branch, and why are you in Mexico? I mean, you're in Africa. What brings you to Mexico?
Thanks, Miguel. So a brief story about my background. I sort of got into this space when I saw Professor Yunus speak about microfinance when I was at Stanford in about 2003, and I dedicated the next phase of my career to microfinance. I was a computer scientist as well, but I moved to Uganda to volunteer for a microfinance institution out there that was essentially giving small loans to a woman that sells fish on the side of the street, and we were able to get her a loan to get a freezer so she could store her fish overnight, or a man who made bricks to buy a furnace so that he could make more bricks. Great stories like that got me really interested in the space, and I saw firsthand how much of an impact sort of being included in a more modern financial system could have on a person. And as a computer scientist, I naturally thought, let's put this on the internet. So I started posting the blogs of these people on the internet and trying to raise debt capital across border for people in this one village in Uganda. And the outpouring was amazing. So this is 2005, before crowdfunding really existed. And I was able to raise millions of dollars this way for Africans, small businesses, in the form of debt. And then we would repay them by wiring the money back to San Francisco. And I sort of got into this whole regulatory mess and how to figure that out, and started a nonprofit in San Francisco. And then over the course of 10 years, we grew to actually disperse over $1 billion to people in Mexico, Latin America, Brazil. Peru is a big market for us, Colombia, Southeast Asia. Cambodia is our biggest market. Kenya is a huge market for Kiva and still going. But along the way, I got more interested in microfinance, and I saw a couple trends. So I saw a really interesting thing, that people, for the first time, were getting smartphones a few years ago, and were able to use things like Facebook, and then WhatsApp, SMS, obviously. Payment systems like M-Pesa were spreading around the globe. And so I could actually transact with these people directly, and I could talk to them directly, even from my office in California. So we had the idea for Branch, was essentially to create a global digital microfinance institution, starting with small loans and then spreading to other financial services like savings as well. So right now we work in Kenya, Tanzania, Nigeria, and we just launched in Mexico.
Ah, excellent. Very nice. Yeah. So it's a great point you make, because I've done a lot of work with fintechs that are doing financial inclusion. In fact, I spent 3 years in Singapore working and developing a model that can predict the success of these fintechs that are doing work to help the unbanked and underbanked. And the model that you have built is a very fascinating one. So maybe can you talk a little bit about how does the model work? How do you guys help the unbanked with the loans? How do you go through that process? And that way can help us then understand, does that model translate across, the continent from Africa to Mexico? How do you see that?
Great question. Well, so we try to think about how to start an MFI from scratch and do it in a digital way. A lot of fintechs have failed because they fail to get distribution. So you can partner with a telco. That's one way people have gone. That's how M-Pesa spread. But it's really hard to create like a payment system from scratch and get a critical mass of users without a big partner like that. But what we thought was just giving super small loans to nearly everybody that downloaded the app was a possibly good way to start if you can control fraud. And so as a computer scientist, I felt like I knew enough to use machine learning to sort of control and manage possible fraud, yet while being fairly generous with issuing people small loans right off the bat. So today we have like over 5 million downloads, and people download this app. It uses machine learning to use a buzzword on the back end, basically combing through the data on people's phones and then turning that into a credit score and then making a loan against that credit score. So if the credit score is really low, it'll give people a really small amount of money, like $2. If the credit score is high, it might give you $40, depending on the market. And it's fairly accurate in terms of predicting people's likelihood to default.
Interesting.
And as we've gotten into this, now we're like 3 years in, thinking of launching in new markets, of traveling the world, going to Mexico, going to India, thought about Brazil, thought about Indonesia. And Mexico just seemed like a great next step for us to launch outside of Africa. Because first of all, the regulatory regime is fairly flexible right now with the new fintech law. And so it's a great set of regulations. It's easy to get started here fast. Obviously, it's a large country, and there's a great need for this. And there are ways that people can repay now through things like OXXO and Connect to Pay and STP and all the fintech startups that are here helping people process payments fast. And then we did test a model. So whenever we go to a place, we test, is our model predictive? We just make a few loans to see if a model trained on people in Nigeria can work and be predictive of people's behavior in Mexico. And we've just been pleasantly surprised. We have the same model trained on universal features like what type of phone people have, how many calls they make every day, how long they talk on the phone, basic things like that that are universal attributes across border, and it really works. So it's not just like an advertising pitch or a buzzword that people say machine learning works. I was skeptical at first, but it actually works, and it works across cultures, across borders.
It's a great point you bring up, because a company like M-Pesa in Kenya, which, if those who do not know M-Pesa started as a mobile wallet and now has expanded to digital payments, lending, savings. But about 40% of the GDP of Kenya goes through M-Pesa, which is massive, right? But M-Pesa had a very tough time trying to get into the South African market. Even within the African continent, they failed 3 times. So it's interesting you bring up that point that you are able to reuse your model in other markets, and there is similarity. What do you think is that point of similarity? Is it the behavior of the customer, or is it the distribution channels? What brings that to happen?
Yeah, well, I think the human behavior in all those markets is very similar. The business conditions are different. So in all those markets, people want to send money to their friends, I guarantee you. So it's not that in South Africa, people don't have relatives they want to send money to. It's just the system there doesn't allow it for a lot of mechanical reasons.
Right.
So M-Pesa is wonderful because it's part of a telco that has a complete monopoly and is partially owned by the government in Kenya, so it's protected that way. So the most powerful business in the country is Safaricom, and it's a very rare country that way, where usually in most emerging markets we would find that the banks are probably the most powerful businesses with entrenched interests in the country, but in East Africa it's kind of the opposite. The telcos are more powerful than the banks, or the one telco is more powerful than all the banks, which leads to this environment where everyone's using the same telco and the same mobile wallet is useful for everyone. So there's no interoperability questions. So every one of our users has M-Pesa. They know how to use it. They know how to type their M-Pesa number into the app. They know it by heart. It's simple. You can send them the money within seconds of downloading the app. They get it. The conversion rate's super high. When we went to Nigeria, it's a bank-led business, a bank-led country. So the banks have all the power. The telcos don't have any power. There's no mobile money there. So we've got to integrate with this fintech that connects banks to the app. And then people have to pay in this other way. And there's a lot of mechanical issues, a lot like Mexico. But fundamentally, the people want to do the same thing. They want to have a way to transact digitally. They want quick liquidity. People want line of credit. They want credit cards. They want business credit, all that stuff. It's just a matter of getting around the mechanics. And then you'll find that the conversion rate is a lot lower in the absence of like a ubiquitous mobile wallet like M-Pesa. The conversion rate, the drop-off, when you're asking people to type in their bank number in Mexico, the drop-off is going to be much more severe in a place like this.
Why is that?
So you're asking people to download an app. They do because they want a loan. And then the next question is, what's your bank number? Because we have to send you the money, and the only way to do it here is if you know your bank number. So you're asking people on a small, $40 phone to type in that bank number, and then, that drop-off, might be you'll lose half the people right there.
It's an interesting point, and part of the reason why a lot of the digital, fintechs or why a lot of the digital technologies, while they have been helpful in financial inclusion, we still see that one of the biggest issues of financial inclusion is conversion rate, right?
Absolutely.
And having people adopt this new thing that they've never used before
And the trust.
and build that trust becomes something very, very difficult and a huge challenge.
That is something unique versus the 5 countries I'm currently working in. I think Mexico has the largest distrust problem.
Is that right?
Even
Wow.
versus Nigeria. You think, you work in Nigeria, there's going to be a massive trust problem. But I swear in my first few months of working here, that's the theme, is users, when they first hear about it, they think it's a scam. And it's like, what kind of scam sends you money? Like, I'm going to send you 1,000 pesos right now. What? That's a good scam? It's like, so, but overcoming that, and I think that's the heart of the conversion problem, is typing your bank account number into an app that you might never have heard of is a fairly dicey proposition in this country.
And to me, I think that relates very, very well with the research that I have done. And, I've done a lot of work. Actually, I did a PhD on financial inclusion and fintech in Singapore.
You should be talking, not me.
No, come on. I want to hear from you. You were the inspiration to my research.
Okay.
But the interesting part that I saw that transfers across and brings up to this point of trust, and conversion rate is this idea of customer centricity.
Yeah.
And being able to have a model that is centric and is really dedicated to help solve that problem for the customer, irrespective of what the technology is, right? And being able to do that. And the toughest part with this type of concept, it is so subjective that many people don't know whether they are really customer centric or not, right?
Yeah.
And
It's
the only way
inherently
you can see it
qualitative,
is if people don't adopt it, right? Or they don't trust
Maybe
it,
I'm
right?
not doing a good job. So what does it fundamentally mean, customer centricity?
It's a great question. And this, by the way, this topic of customer centricity has been studied tremendously across the marketing sector over the last 50 years, right? Many banks, many companies use it. Today's world, as we're seeing the digital transformation of banks, the key aspect is how do you become centric to the customer? How do you help them with that journey? So it's really putting your entire organization not around the product, but around what are the problems you're trying to solve for your customer.
Nice.
And then measuring that against your customer, not against your product.
Yeah, so how do you measure? Is it surveys or how do you measure this?
It's a great question. And one thing that I was able to do with this model is develop a customer centricity score that people haven't done before. And I was actually very surprised. I poured through all the research and said, wait a second, nobody has a score that can measure customer centricity. It was mind-boggling to me, but in essence, there are some key dimensions that you can operationalize for customer centricity. The first one is around how much do you know your customer? How well does your founding team, your management team, know the customer? And what I mean by that,
each customer, just understand the general customer.
Exactly, understand the general customer, but even going a little bit deeper and meeting with the customers, because a lot of the way you understand the customers, you have to empathize and know what they're going through in order to be able to figure out how do you solve that problem. The second aspect is around the design of your product and how intuitive, how easy it is to do a transaction. Like you were saying, nobody wants to type a bank account, too much work, right?
Yeah.
So that part makes it difficult to be more customer-centric, right?
Yeah.
At the same time, how long does it take you to do a transaction? The term that a lot of banks use, do you delight the customer, right? Yeah. To help them be, happy to be able to do this, right? And change their behavior because they're not used to doing this.
So how's it different than like Net Promoter Score, for instance?
There's not much of a difference. There's some similarities.
Okay.
But the approach I took was more of, looking at breaking out the different factors to look at.
Multidimensional.
Multidimensional. So it was based on a series of survey questions. And then the next aspects are around what metrics do you use to measure yourself, And here is where you look at Net Promoter Score, but also you look at things like customer acquisition cost, customer lifetime value, how that ratio is working. You usually want to make sure that customer lifetime value is significantly higher than your customer acquisition cost.
What's the right ratio? So how long should it be before the customer pays back the acquisition cost? That's always a fundamental. In tech,
that is your world, Matt. I'm the researcher. I'm just telling you what I see. Yeah. But no, it's a great valid question. I don't know the answer. Okay. But ultimately what my research was able to show is that with this customer centricity score, there's a very direct correlation with the financial performance of the startup and with how many people can you actually help and how many people actually can use your product. So that has been really, really helpful for the startups that were part of the model that I participated in. And truly, it's been an interesting way of thinking about it. Is it perfect? No. But it is a great start and a great reference point that you can refine from there. So, but yeah, that is an interesting point. The other point that I found in my research, and maybe you can comment a little bit about this, is around strategic partnerships. And who you partner with becomes also very important in terms of whether you can succeed or not. And typically you can think of in the financial inclusion world or in the developing markets, because the mobile phone is your main distribution channel, partnership with mobile network operators becomes critical. Yet my model didn't show that. My model actually showed not really that much of an interaction, but partnerships with financial institutions was very strong. So maybe, the very brief moments we have, talk to us about partnerships. Do you have partnerships with mobile network operators or with banks, and how does it work for you, and what do they bring to the picture?
I've tried all the above, and a lot of these partners are slow to sort of get familiar with fintech, so I feel like a lot of them are catching up. And companies like mine have to take all the risk and potentially fail, and when they figure out that you're not going to fail, maybe then they want to partner. So I think we're just at that point. When we started, the predominant model in mobile lending was to partner with a telco, and there's a lot of great companies that do that in Latin America, and then sort of make loans based on the telco data. And I'm not very good at biz dev, and I never wanted to sort of be beholden to a large monopoly like that. So the thing that got me into this industry was realizing I could do it without that partnership. We could lend to people over the top. We could create a great brand with our own customer service. We could own the customer. We could introduce new products and adapt to their needs and be customer-centric over time. And when you partner with the telco, often what you're trying to do is solve a churn problem. Yeah. So I've seen a lot of the fintech companies that partner with telcos, when you really see what they're doing under the table or just closer to the product, it's really solving a customer churn issue, which isn't like solving a churn issue for like Tigo or Airtel doesn't really appeal to me as like why I'm here to do this work. So I really wanted to find a way to do it as an MFI and a great brand in and of itself. So we just tried to go the independent route. And the main problem with that is you got to acquire all the customers yourself. But we found that it's so popular now, the need is so severe, and people just don't have access. When you're competing with MFIs or like Comportamos or manual lending like that, the customer experience is so much better through a phone that it's pretty easy to acquire customers. So you don't really need to partner. I think you need to partner with financial institutions because you need a lot of money, right? So we have Victory Park as an IFC, as two of our financial partners that help provide the cash that we lend out.
Very nice. So in the very short time we have, which is very short.
20 seconds.
20 seconds, yeah. What advice would you give to any fintechs in Mexico that want to help the unbanked and serve the unbanked? You've had experience as a serial entrepreneur already. What advice do you give to people? Because it's a tough sector to get in, right?
I'd say it's getting a lot easier, and you should be optimistic. Like, take the risk. If people are inherently skeptical, if you just lend to people, isn't there going to be a lot of fraud? Isn't there going to be, everyone's going to default? And it's completely addressable, and now is the right time because of the spread of the smartphone. The time is now. It's a great time to get into this space.
Very good. Well, thank you, Matt. Thank everyone for being here with us.